Assalamualaikum warahmatullahi wabarakatuh. For our financial accounting for assignment, we're gonna do presentation about introduction to the companies. So companies in Malaysia usually incorporated entities which is under the Companies Act 2016 or under previous act which is Companies Act 1956. So for the classification of the companies, we have three classification, which is the company limited by shares, guarantee, and unlimited liability company. So for the company limited by shares, each member obligation to the company is limited to the amount. So if any unpaid on share paid by the members. So in the event of liquidation of the companies whose shares have been fully paid up, so they're not liable for the company's debt. Next is company limited by guarantees. Members' liability is limited to such amount as the member pays to contribute. So usually this company do the recreation, amusement like that. So they apply its profit to promote its object and cannot pay dividend to their members. So lastly, unlimited liability company, which is they have no limit placed, and their shareholders required to contribute to the company's assets to pay the company's debt. So move on with types of company. So the first one is a public company, which is they need the word berhad in their company, and they have no limit on the maximum numbers of shareholders. Next is private company, which is they need to have the word sendirian berhad, and their members must not exceed 50, and they're using liability limited by shares. So next is exempt private company, which is they are also private company but with no more 20 members. So they need not to file its annual financial statement. So the fourth is a foreign company, which is they are incorporated outside Malaysia. And for the last one is a government-linked company, which is for this company, government own sums of or all of the shares capital. So it can be either a private or public company. So they are concentrated in specific industry to boost country's economic development. So yeah,
based on CCM. Name of company, type of company, address of registered company, information of owner and partners, details number of shares, and provide a copy partnership agreement.
Financial reporting. Financial reporting involves the report of financial information to the various stakeholders about the financial performance and financial position of the organization. The importance of financial reporting cannot be overemphasized. It is required by each and every stakeholder for multiple reasons and purpose. Company Act 2016 asks the accounting records to be kept, annual returns to be submitted to authorities, financial reports and statements prepared by the directors and manager as to capital and borrowings. Financial Reporting Act passed by Parliament in March 1997. There are two important independent bodies formed, which are Formation of Financial Reporting Foundation (FRF) and Malaysia Accounting Standards Board (MASB). So for the function FRF to be responsible for the operating activities of MASB, Review the performance, financing, arrangement, and operation of MASB to administer funds. So for MASB, to issue accounting standards and to issue statements of principle for financial reporting. Bank Negara, Securities Commission, and the Companies Commission of Malaysia should apply the financial reporting standards issued by MASB for their financial statements.
The annual report is a compilation of the report and financial statement required by law or otherwise to be sent shareholder in 14 days before the annual general meeting. The element of the annual report is chairman statement, corporate governance statement, audit committee reports, statement on internal control, social responsibility statement, and financial statement.
Okay, next I will share about the legal requirements in Bursa Malaysia Securities Berhad. Firstly, listed companies have to make additional disclosure regarding the performance of the company. Second, they are required to make a preliminary statement of result within 6 months. And the last one is to issue half-yearly reports regarding their performance within the 3 months.
Okay, I will present about advantage and disadvantage change from partnership to the company for our business. Okay, first of advantage is liability protection. Shareholder do not risk losing personal asset because of a company debts, because company are considered separate legal entities from the people who own them. Second, access to fund. Company can more easily raise fund than partnership. Company can sell stock to raise money for business expenses or cover debts, but partnership must try to come up with funds on their own or turn on loan or credit program. Third, tax benefit. Company can enjoy some tax benefit. A company is not required to pay tax on earning paid as compensation to employees or shareholder, and it deduct the payment as a business expenses. Also, company tax rate lower than personal and partnership tax rate. Okay. Fourth, professional management. In company, the management is in the hand of the director who are elected by the shareholders and are well experienced person, while partnership need to consult and discuss matter with your partners. Okay, last of the advantage is transferability of shares. If the shareholders of a company are displeased with the progress of the business, they can sell their shares anytime during all this change of ownership. The business continues to operate, but in partnership, a partner cannot transfer his shares to other without the consent of other partner. Okay, I will continue to the disadvantage of company. Lack of secrecy. A company has to make various statements available to the financial institution. The secrecy of business come down. In partnership, business can keep confidential by the partner. It is further reduced when the company provide its annual report to the shareholder, as the competitors do also find out the detail of all financial data. Okay, second restriction, compared to the partnership, a company has to comply with more legal requirement. It consumes considerable time and effort. Third, complicated to set up. In partnership, can straightforward register with the HMRC, whereas setting up a company will mean registering with the company's house. You will also have to repay a fee for setting up. Fourth, decision making may be slower. In company, no single individual can make a policy decision. All important decisions are taken either by the board of directors or are referred to general house. But in partnership, better decision making because they need to discuss with their partner only. Okay. Lastly, complex account. Company account can be complicated compared to the partnership. This will require this director to record information on monthly basis. Some of the things that need to be covered are tax return, business expenses, and keeping the business account up to date. That's all from me. Thank you.
So next is the differentiate element of disclosure in financial statement between the company business and partnership business or sole traders. The first one is the statement of equity. The statement of equity is both partnerships business and capital business produce a statement of equity or also called as retained earnings statement. In a partnership business, the retained earnings statement shows each partner's business equity along with the total equity. While for company's statement of equity, it only has one column that shows the total equity. Both partnerships and company have the amount of capital that need to be reported. The second one is the balance sheet. The balance sheet, or also known as the statement of financial position, is a statement that records business assets, liabilities, and owners or partners' equity. In partnerships business, it only shows each partner's equity with a total. But for the company business, it shows total for shareholder equity. The next is the income statement. The income statement or profit or loss statement shows a business income and expenses over a set of period of time. For partnership business, the statement shows the distribution of profit and loss for each partner. While for the company business, it has a changes in equity, where changes in share capital, profit, revenue, and other capital for the year. Okay, so the next point is company ownership. In a partnership business, the owners are a limited group of people who have decided among themselves. This decision usually is based on how much money each has put in the company, while for the company business, the ownership is allocated by stock. The last one is the distribution of profit or loss. In partnership, profit or loss made by a firm among its partners, which means it's distributed according to the partners of ratio agreement. Okay, for the company business, the company profits are distributed in three ways, which is taxes. Taxes is to pay company profits tax. The second one is profits retained. These profits retained by company to finance capital investment. And the last one is dividends. Dividends is to pay the shareholders. Dividends is paid to shareholders or company owners. That's all about the element disclosure in financial statement between the company business and partnership business or sole traders.
Conclusion. In this chapter, give an overview of the legal aspect of company formation and financial responsibility of companies. That's all from us. Thank you.